Hello and welcome to Innovation in a Pandemic, the first session of Series 2 of Primetime virtual events brought to you by P.R.I.M.E Finance. My name is Camilla Macpherson and I'm Head of Secretariat. I'm going to start with some housekeeping. This session is made up of two panels, each running for 1 hour. The first is on new technologies, the second is on digital currencies. There'll be a 5-minute break in between the panels, but there's no need to dial off, just stay on the line while we move between the speakers. This session is being recorded and will be distributed later. The attendees are muted and have their video turned off. If you have a question or comment, we'd love to hear from you. Please get in touch using the Q&A function on Zoom. It'd be great if you could include your name and affiliation. We'll be using the chat box throughout this session to send messages to all attendees. I'd like to thank Droit Financial Technologies, FTI Consulting, Morrison & Forster LLP, and Rutter Associates for sponsoring Series 2 of Prime Time, and D2 Legal Technology for sponsoring this particular event. We value your support. Thank you also Lexis and MLEX for assistance with promotion. I will now hand over to Lisa Curran, Senior Counsel at Allen Overy LLP and Prime Finance Expert, who will introduce the panel and moderate this session. Thank you.
Thank you very much, Camilla. You've said that I'm a Prime Finance expert. One thing I am not, just an upfront disclaimer, is a fintech expert. My only claim to having some legitimacy and being involved with today's panel is linked to our topic, which is all about harnessing technology to manage complex information sets, including in the context of regulation, financial risk, and the digitization of legal agreements and advice. And on that last note about digitization of legal advice, well, I am Italian counsel to ISDA, and in that capacity, I produce on a regular basis hefty 100+ long pages on things like netting and collateral enforceability. And I know firsthand just how difficult it can be to, and overwhelming in fact, to digest the information that's in those opinions. But that's exactly what banks need to do if they're going to use the opinions for regulatory capital purposes. And this is just one example of where fintech can make such a difference, and that's what we're going to talk about today. So as I say, I am not an expert in fintech, but luckily we have 3 panelists who certainly are experts. Each is a founder and or CEO of cutting-edge firms active in this space. I'll be very brief because we have a lot to talk about, but you have their full bios. We have Akber Datoo, who is founder and CEO of D2 Legal Technology. We have Brock and Arnason, founder of Droit Financial. And we have Walter Gontarek, who is CEO of Channel Capital Advisors. So we're going to dive in right off with a question first to each of our panelists. If I could just say one thing, we are going to, we encourage, as Camilla said, we'd love to hear from the audience for questions and whatnot. We're going to first allow the panelists to run through their presentations, and if you can send your questions through the Q&A function, and then we will get to those. We're going to save time at the end to get to those. So the first question that I have for each of the panelists is what problem you each propose that technology should be used to solve? And I'll start off with Akber, then we'll hear from Brock, and then Walter. So over to you, Akber.
Thank you, Lisa. And yeah, I'll be looking at one of the things that you mentioned there in terms of the automation of legal advice and opinions, and talking through how we can utilize data in order to optimize our business decisions. Technology and data really need to be better harnessed to allow us to give life and effect to the advice that we find in complex legal opinions that really run at the heart of the financial services industry. And, you know, I'd see things such as the closeout netting legal opinion being one of those. I remember very clearly Jeff Golden, so founder and chair emeritus of Prime Finance, sitting me down a while back. And little did I know the significance of the words that he would impart to me. And you know, it went along something like this. He said, Akber, if anyone asks you a question and you don't know the answer is undoubtedly netting. You know, as hopefully some of you know, I think that is very, very good advice looking back on it in time. Now, closeout netting, just by way of a kind of very quick introduction, is is a vitally important risk management tool. And Lisa, as you alluded to, prudentially regulated financial institutions are required to provide regulatory capital to cover their exposures. Now, where effective, closeout netting means that only the net exposures need to be covered as part of that. Now, this translates, the question of whether you can net or not, translates into a $1 billion saving question for the largest investment banks. And so, I guess just touching on the context before we get into the detail, when is it effective? Well, that really is the subject of your closeout legal opinions. The basic conditions for it are that, for closeout netting, are that there should be an effective netting agreement between the parties that provides for a single net amount to be payable on a party's insolvency. And that needs to be supported by reasoned legal opinions confirming the effectiveness of the provisions in the relevant jurisdiction. So maybe I hear you saying, what's there to automate? Where does technology and data come into this? Well, let's take England and Wales. The is there closeout netting legal opinion, a bit longer than yours, Lisa, looking at Italy, it runs to 228 pages. That's filled with assumptions, qualifications, conditions, reasoning, but downstream, fundamentally, to make the bank work, to worry about that regulatory capital, to worry about risk management, what do we need? We don't even need a page. We need a simple binary yes or no. And that, if I can just put it to you, is a lot of manual work. And we will see a lot of operational risk. And that's where data, taxonomies, clause libraries, and systems come in. Effective closeout netting is a dynamic, not a static concept. And that further adds to the need to not manage this manually, but to embrace systems and data.
Thank you, Akber. And Brock, could we hear from you? What is the problem that you are using technology to address?
Thank you again. So the way that I would describe this is at a very high level, we are in the business of computational law, but more precisely, we are in the business within the context of a financial transaction of determining whether the nature of the financial transaction is compliant vis-a-vis the laws that govern what needs to be done with that transaction prior to execution and with respect to obligations that may exist post-execution. So the problem space is really one of understanding the rules of exchange. So if you imagine that, that this is an industrial process, because that's the way that we try to approach it, we will look at the space and say, there are hundreds or even thousands of sources of regulatory change, right, that dictate what laws may apply to a transaction. So those can come from different regulators, those can come from direct governmental organizations that publish law. What we do is we take that information, we parse it into a standard format, we codify it, and we then create something that is operationally evaluatable, right, in the context of a transaction. So the problem that we're trying to sort out is, can I do this trade, right? Can I legally do this trade, and can I do this trade given the conditions of the market structure in which I operate? So that resolves down to thousands of individual questions, things like, is this transaction clearable at a CCP? Must I execute this on a CEF? Is this listed on that CEF? If so, if I'm trying to do this trade bilaterally, do I have paper in place that can actually allow for compliant margin exchange? There are many different questions that you would need to ask. The way that we approach that problem is we look at it as one of, I need to understand what all these sources of change are. Every time there is a modification to a law or a legal rule, I'm going to bring that into a normalized standard format in which I can look at that as data. I then am going to imply logical relationships through a process that we call annotation, build that up into logic that can be evaluated given facts about a transaction. And then I can have a decision service that actually will tell you in the scope of a transaction which particular rules apply, what the obligations are that are created, who bears those obligations, and creates a visual record that you can then use for audit purposes after execution of a transaction to see that decision process and to trace it through. So the service that we provide to our clients is one where we say, if you license these particular regulatory rule sets from us, we will maintain them for you. We will give you a mechanism for evaluating on a per transaction basis what your obligations are, and we will be able to tie every point in that decision back to the pin site in the regulatory text from which the obligation derives. We do this for law, and we do this for what I would consider market infrastructure rules, right? So things like what is clearable at a venue, right? What are the types of margin that you can post under this particular law and at this particular CCP? What particular exchanges are available for you to transact a product, et cetera.
Okay, thank you.
Brock, can you hear me?
Yes, I can.
Okay, I think I'm going to just start now. I couldn't hear Lisa completely, but maybe it was something on my end. So with permission, I'll just proceed, please. So first of all, good morning, good afternoon, and good evening to everyone.
Oh.
I hope everyone is doing well. Okay, I think Lisa's dropped off. Let me carry on, guys. My name is Walter Gontarek, and I'm the CEO of Channel Capital Advisors. And I've been a prime finance expert since 2012. And I'm very pleased to be here today and talk a little bit about the journey that we're taking. Lisa has asked me to consider the question, what role is technology playing in our lives, especially since the pandemic, in terms of managing securitizations and managing financial assets? We're an asset manager. I doubt very much there's a lot of investors on the line, but there are a lot of service providers and folks that are involved in the background in investing. So Lisa, the answer to the question is, I would like to talk a little bit later on about how technology can be brought to the fore in terms of managing financial assets in a pandemic, in some of the risks that have been identified. I note that Ed Altman has identified and predicted in his research a month or two ago a significant increase in default rates. This morning, S&P announced a growing concern regarding insolvency in Europe for SMEs and medium-sized companies. So we certainly have growing credit risk trends, growing non-credit risk trends, fraud risk trends. So I would like to talk in a couple of minutes, please, about how technology can be brought to managing pools of assets to mitigate these risk profiles and make them acceptable risk profiles for institutional investors. Thank you.
Okay, thanks very much, Walt. We're going to do exactly that. We're going to get back to, in fact, we're going to circle back now, if I may, to all of the panelists. And what I would like you, well, you picked up on the pandemic in particular and how the pandemic has forced us to change how we work, how we think about the future, and also with regard to the use of technology. So if I could just circle back, I'll start with you, Akber, just asking you to describe the solutions. You've given an introduction, but get into a bit more detail, the solutions that you're going to apply to the problem that you spoke about earlier, and consider how the pandemic has forced us to change the way we think about technology in this way, in this space.
Thank you, Lisa. So, you know, amongst this crisis, you know, it's clearly upended numerous lives and continues to be this veil of uncertainty, you know, on the future. One thing I think is immediately very clear to all of us, you know, we are living, because of the pandemic, in a far more digital world. So, you know, governments around the world have initiated lockdowns, and the demand for digital services and products across customers, clients, and employees kind of stuck at home has hit record levels. And digital activities are becoming standard behavior and expectations. And the capital markets, the financial instruments at the heart of that, I mean, I'd like people to consider it as simply being a series of contractual obligations. But unfortunately, those are buried away in a mountain of paper-based contracts. We very much have an analog view of this today. And that paper-based world is frankly no longer tenable. Are we able to sift through our drawers in order to find that vitally important amendment agreement? Do we have the ability for our signatories to provide that wet ink signature? And why is it that for every other walk of life, we have moved into a world that is far more technology enabled, despite it being the tech-enabled banking world? Why is it that in other walks of life, I can generate documents, I can negotiate things online, we can sign all sorts of agreements like tenancy agreements using digital signatures? And why is it that we need data rooms of documents looking for libel fallback provisions? We're living in a world where Google has been around for a very long time. It even became a verb over a decade ago. And on the basis that Jeff's words, to me that I relayed earlier, his words of wisdom 15 years ago are still true, and the answer always is netting. I want to explore how we embrace this important digital journey that's been thrust upon us in respect to that plays out a netting legal opinion. But the principle, that we're going to go through really is the same for any sort of complex legal advice or opinion that we might come across. Now, I think very quickly, when we think about the impact of COVID and the pandemic, it's important to say that this digital agenda, it isn't so we can just continue to work from home remotely and avoid our kind of journey and commute into work. We need to really understand the business value that this can unlock. And I think if we can harness the information and data that is contained within those contractual terms and advice, then we can optimize capital, liquidity, and collateral. And it becomes a key part of the business model. And it's that aspect that I think the pandemic is really bringing out. Those firms that are able to move to a kind of data at heart mentality and optimize and embrace this digital agenda that is becoming far more pronounced. Now, at D2LT, we ran a survey last year we had 20 financial institutions take part. And, for me, it was rather a concern that only of the poor 20%, 4 of them, had any concept of data lineage when it comes to that netting determination. And what do I mean by data lineage? Well, how did we reduce that 228-page legal opinion, or at least your 100-page legal opinion, into that yes or no? What is the audit trail that we have in order to do that? It's about reading and understanding that opinion and merging it with client data, with product data, with transaction data, with legal agreement data, in order to support that positive or netting or negative netting determination. And it really just isn't good order. We are being forced to do this, quite rightly so. It's the demand of the regulation. One only needs to consider things such as BCBS 239 when we think about the critical data elements that we are required to have and maintain in an accurate and timely manner for risk aggregation purposes. And when we've been working with different firms on their BCBS 239 compliance, I feel it's a real shame that it's been in areas of closeout netting where really the house has not been in order. One of the things that's been quite pervasive throughout has been, a very poor level of counterparty type data that is crucial for the determination. And there is, if you want to fix something, you really need to understand what you're fixing and what the current state is today. But what we saw really is a very poor level of understanding of that data accuracy. We came across a large investment bank that had a positive netting determination for a Scottish counterparty, but unfortunately it had a positive determination for the wrong reasons. In its systems, it had tracked this large kind of Scottish entity and tracked it to the England and Wales opinion and forgotten about the laws of Scotland that really need to apply. Same results, but where is the controls that our prudential regulators rightly demand on that? Mind you, the Scottish opinion, slightly shorter, 65 pages, but still, again, a very long way away from that single yes or no. So what is the way forward? How can we treat this in a positive way and not just a compliance? How can we lead to RWA reduction and capital optimization? And it really comes down to ensuring that we have the structured data that we need in place that is required for that netting determination. And I'd like you to think of that netting determination as a long relay race. You know, it touches on a number of different departments in an institution. But unfortunately, it's the relay race where every time we pass on that baton, you know, be it from sales to onboarding to legal, documentation to credit risk, XVA, all the way through to the regulatory capital calculation itself, we just keep dropping the baton. And why is it? It's because we need the taxonomies, we need the data standards to help manage the vernacular, to be able to talk in that consistent language, both within a firm, but also as an industry, because it's only when we do it as an industry that we will truly be able to automate and realize some of the efficiencies here. So we talked about a counterparty type taxonomy, one that can support the lineage to the types supported in the underlying opinion. We talked already about the jurisdictional taxonomy, one that is, you know, there's the right safeguards around it that we don't forget jurisdictions such as Scotland. Thinking through the agreement types, because the legal opinions will differ based on the agreement types that you're looking at. Now, you might say that's very straightforward. It's an ISDA, it's a GMRA, it's a GMSLA, it's an MRA, etc. But it's not the case in terms of what we see in terms of process and systems. We're working with one large investment bank. They had a list that was 562 strong of the different agreement types that you could select in their system that ultimately led to that netting determination. I'm not sure many of us would come up with 562 different netting arrangement types, but essentially what they had is, well, maybe if I tell you about the system first, you could only see 15 of those choices at any one time. So if you happen to need to select a agreement type that was at the bottom of that, you would need to actually click 37 times on a button in order to get to the 38th set of counterparty choice, agreement type choices that you had. And, you know, in the age of fintech, embracing the digital, the client, the user experience, where has that gone? And how many of you would have the patience to click through and get to the bottom? Whereas, you know, when you look at the list, it had things in there such as ISDA 92, but further down, 92 ISDA. So which one is it? In a data-centric world, you know, although a lawyer might argue with you to say, well, you know what we meant. But as far as systems and data goes, it's imperative that we get that right. And the more pertinent question ought to have been, was that a multi-currency? Is the 1992 agreement or single currency? And furthermore, you know, we might even start to think through, well, why is it that we didn't simply align precisely what was stated in the legal opinion in terms of the coverage of that opinion and match it exactly to what we have in our systems? Because, you know, if we could do that, it would simply be a case of a data flow. It wouldn't need anyone to read anything. The legal opinion in a digital form in the future talks to our downstream systems. We need to do the same for our product and transaction taxonomies. And coming back to the legal opinion itself and digitizing the legal opinions, standards, common ways of expressing, hopefully in a data form, the assumptions and qualifications that we might have to present in these opinions. And also the language that is identified within it, the required language. For example, amendments to the bankruptcy clause that might be vital in order to achieve a positive netting determination question, which does raise another question as well. Where are the clause libraries and clause taxonomies that help us store and manage this information that we need to ultimately get to the right determination or to put documents in place that achieve the right answer? Why is it that as an in-house lawyer, I need to look in multiple places across a variety of different templates that are quite disparate across jurisdictions or counterparty types. I then also need to look at a legal opinion in order to find what's needed. Why is it that I don't get an alert, for example, when a new opinion is provided, it changes the language that's needed, and it just automatically updates the template that I will be using? I mean, this is the customer and user experience that really fintech, legal tech really ought to be providing to us. And then you also need to think about the data model to represent the legal agreement terms that would allow us to automate that determination and generate an audit trail. At the moment, we have, frankly, a black box where the lawyer takes the in-house lawyer takes the legal opinion and reads it, comes to a decision, and records a yes or no, which fundamentally stunts our ability to be able to automate this area at all. This really isn't, the cutting edge of technology. It really is just taking a sensible look about how we need to apply the legal opinion and advice going forward so we can automate this long relay race and get those changeovers of the baton correct. And we can also, it allows us to then embrace rules engines that can take a whole host of inputs and help us automate the decision, the sort of rules engine that we will hear more from Brock on as well. And we can then turn it on its head. We can then run what-if analysis and basically say, well, where did I get a negative determination? And where was that because of my legal agreement terms not being such that they could enable me to get the outcome that I want? And that's where we start seeing the real positives of embracing the digital agenda and the regulatory capital savings that it can bring. I just like to kind of end on just a bit of a thought, I guess, for everyone. In late 1995, Richard Susskind was branded dangerous, was the exact word used by the Law Society of England and Wales, because he claimed that email should be embraced by the legal profession. And I'm sure you all know where that worked out. But let's extrapolate. There might be many here who say that this is something that is not amenable to automation and data. Maybe it won't be in one big step, but we certainly need to be considering the direction that we're going in. And perhaps, maybe, the next time Jeff asks the question, it really will be Alexa that answers netting.
That's excellent. Thank you, Akber. Apologies for my bandwidth problems earlier, everyone. Brock, can we hear more about your technology solutions?
Certainly. So I'd like to take a bit of a step back, and I'm going to address the theme, right? So the theme here is, in the wake of a global pandemic, in the wake of COVID, what have we seen that relates to technology, legal innovation? What new problems have been created? What existing problems have been exacerbated? So if I really move to this sort of 10,000-foot view and ask this question, I would have to say that the biggest accelerant that we've seen is an emphasis on digitization, right? Now, digitization is a code word that you can fit a lot into, right? So it can represent every new technology spend item at a financial institution. But at its core, I think that the real intent of digitization as a strategy and as a thematic investment is to reduce your marginal cost of adapting to change, right? So what does that mean? That means that in a world where you don't have people sitting in the same region and able to communicate with each other, they're all sitting in their own silos, right? The only way that you have to interact with each other is via technology. And you can rely a little bit less on the kind of in-person interactions that are less formalized and structured. What does that mean? that means that when you have something new, right, there's less of a kind of opportunity to interact, to foment, to respond in a traditional way. If you are looking at regulatory change, if you're looking at a change in documentation, if you look at a change in the way that a customer wants to do business, to react to that means that you need to have means of connecting people, but more importantly, in terms of operational process, you need to have a data-driven model of how you're responding. So if you can codify that and you can respond with an architecture, an operational architecture and a technology architecture that is responsive to the underlying model of what is changing, rather than having a kind of expensive, code-based process around it, or relying on people to sit in a room and work something out, then you're going to be able to be faster and you're going to be able to respond at lower cost. So I'm going to call back to something that Akber is talking about here. Looking at legal documents, right? They are a rich source of potential information, right? Not only counterparty specific negotiation of contract terms, but just in terms of looking at data elements that drive decisions in the context of a trade, there's massive amounts of detail, right? The information that's codified in a CSA is extremely important when understanding what types of transaction you can do with a party and what their implied costs are going to be. And the more that you can pull that out and the more that you can be responsive as the actual data changes, the better you can create a dynamic process that that allows you to see opportunities that some of your competitors might not. So I'm going to talk a little bit about what this means in terms of decisions, right? So moving to a data-driven model means thinking about standardized data representations, right? We see this in the industry with the emphasis on things like CDM, and before CDM, FPML in general, right? These are attempts to codify and standardize products and many of the legal terms that relate to them contractually, but also life cycle events around them, some of the more operational process-driven ways of thinking about these products. So if you can relate a model of your financial transaction to a model of what the law is and a model of what your legal agreements are, now you can actually start automating and mitigating your operational risk. So this requires another form of modeling and thinking about digitization, and that is fundamentally one of decision-making, right? So understanding how you arrive at decisions requires a certain ability to introspect. So provenance is something that Akber was talking about. Provenance is very important when you're looking at different transformations, right? To understand how a data element went from here to here to here. But it's also important when thinking about the evolution of the law or the evolution of a contract. What version of reality applied at a given point in time? How do you tell what version applied? How can you explain a decision that you made 2 years ago when all of these moving parts have reconfigured themselves in the interim? And how can you justify that to a regulator? So we've seen a lot of buzz in this space about AI. And the modern definition of AI isn't one that actually has a lot of explanatory power. This is one of the big weaknesses of some of the big leaps forward that have been made in this space. So artificial intelligence, as it is commonly perceived, really relies on the training of a very specialized type of neural network on a huge number of inputs to be able to have a kind of statistical predictive power. And that can be very useful when it comes to certain types of problems, right? Forms of NLP to be able to extract data elements from documents, certain types of predictive decisions. What it's really poor at is saying why it came up with an answer, right? So if you're trying to make a decision about I'm allowed to trade, right? You look at this in a pre-trade context and you say, why am I allowed to do this transaction? And you have, you know, an algorithm that tells you there's a 95% chance this is legal. That's not very helpful if you don't have any reasoning behind why that's the case, and you can't actually tie that to a model of the law. So the provenance of your data, your ability to represent your decision-making process itself as a form of data, these are the problems that I think are at the heart of what we call digitization. And we have a very specific approach to this, right? Our specific approach is one that is fundamentally driven by a visual representation that is tied to versions of a logical model that is tied to versions of the law. And the intent is to be able to have as sophisticated as possible a decision process, given the data that it's available to you, and that we can provide that as a bit of a service. So just to give people a brief idea as to what I actually mean when I talk about these things, I'm going to take just 1 minute to give you a very, very quick overview. I'm going to share my screen. Give me one moment here. Okay. So when I talk about visualizing decision, what I mean is to be able to see the law as a kind of decision diagram. What you're looking at in this picture is a particular transactional decision in the context of a MiFIR classification. So determining whether something is a financial instrument as classified under MiFID II. So you can see that there's a decision path here, right? Is this a security derivative? Is it an interest rate derivative? Is it a currency derivative? Is this subject to something called the FX spot exclusion? And then you come to a conclusion. And the conclusion in this particular case is that this isn't a financial instrument. But how do you know where this comes from? How do you tie this model of the law to the actual law itself? Well, you can do that in this particular example through a process of annotation and linking to an annotation. So I'm going to take you to that particular view. So I'm looking at this particular decision node and tracing it through to the point in the law that drives that obligation, right? And you can see this is an actual structured representation of the relevant law. So this is Reg 2017-565, MiFID II delegated regulation. Is this a spot contract within this meaning? And we've taken this legal text and we've marked it up. And we've said this is a constitutive definition. This is the defined term. This is what it means. And by the way, here are all the points in a logical model that refer to this individual part of the legal text. As this changes, you can model a change in text and associate it with the change in logical representation. But you can apply the same way of thinking far beyond what we provide as a software vendor, right? You can provide this type of model for every data set that you think about as a firm. And I guess to conclude, what I would say is that this process of digitization is only going to accelerate. There are going to be more and more complicated market structure rules and regulatory rules that will apply in more onerous ways to different participants in the marketplace. It's very important for all of these participants to understand and have a model of those rules. And the better their understanding, the more automation will be possible and the lower their cost is going to be going forwards. So we think that efforts around codification and standardization of the legal texts, around the law itself, around internal decision processes are all going to interact, and the financial institution in the future will be one where you get extreme visibility into the decision making and the ability to attest to how you made decisions at all points of your operational workflow. Thank you.
Thanks very much, Brock. I do like the sound of this brave new world of visibility and traceability of decisions and whatnot. Walt, let's hand it over to you. You took very little time by way of introduction, but I know you have a lot to tell us now about your products.
Very good. Thanks, Lisa, and hello to everyone again. I'm just going to share, please, with permission, a couple of slides about our observations here. I'm just going to now run slideshow. Hopefully that works. Can everyone see that? Lisa, can you see that?
Yeah, absolutely.
Okay, great. Guys, I'm just going to go through a couple of slides here. And starting out with, oops, it's moving, it's changing for me. Great, thank you, automatically. Wow. Again, the question that I'm focusing on is very much how technology can be used to manage risk, given these enhanced risk profiles that are likely to be associated with or driven by the global pandemic. These are financial assets. These are loans, these are bonds, these are receivables, these are real world securitizations or loan portfolios or credit portfolios, and how are investors responding for the past six, 7 months in terms of better managing risk and stepping up to the plate. Clearly banks, investors, and the capital markets broadly are braced for an enhanced risk environment given the residue of the economic shock relating to COVID-19. I touched on earlier in our comments, S&P this morning came out for a European prediction. I know we have folks globally on the call, and that's great, but with a significant and worsening credit environment on the back of the economic fallout of the pandemic. We know at Altman, as I mentioned in my earlier comments, is predicting that the bankruptcy expert from NYU, the default expert, is predicting higher default rates in the speculative grade asset classes. And this affects lenders, this affects banks, investors, and others. How do we prepare for that? So what we're seeing and what Channel is doing, but what boards I'm involved with and friends of mine that run risk portfolios are now beginning to respond to that by embedding significant risk management enhancements given this environment. And our experience at Channel is only one vignette of this journey, just one simple vignette that is really occurring at the same time. Some of you might be saying, hey, well, stock markets look pretty good to me. What do you mean there's credit problems out there? Don't be fooled, don't be fooled. Technology, however, is playing a key role in supporting securitizations and risk management. They're sponsors of securitizations and investors in this dynamic environment. And I know that's something that P.R.I.M.E has a lot of experience with, given my role as an expert for many years in helping judicial players, helping investors understand complexity. So this is the link with my comments. I'm not going to spend any time on this other to say any of you that are on the call, I can see there's approximately 70 attendees, and I can see some of the names. There's some experts in the securitization area and capital markets area, and all of you would in that area would know how securitizations basically work. On the left-hand side, this is an example of an SME structure that we executed this morning, in fact. Ideally for today's conference, I can tell you we completed a pan-European SME receivable securitization for a client based in Ireland, and I'm very proud about that. And in this case, we have sellers, which are sellers of receivables under a receivables purchase agreement, selling to a compartment of an SPV platform in Luxembourg, and that's called Channel Finance. And that's what my firm at the top there manages as program manager. And that issues debt notes, senior and junior debt notes. We're usually the investor in junior notes often or sometimes. And then there's embedded trade credit insurance policy from the leaders in the trade credit community. And then there'll be an originator or servicer of the assets. This structure was very similar to the one executed this morning, breakfast time in Europe by Channel, just ironically, it's only our 8th transaction this year, but still not bad. So this is very typical true sale securitization, multiple stakeholders, guys. We have junior and senior investors, we have a manager, we have a servicer, we have the SMEs themselves, we have the customers of the SMEs, our stakeholders, and the insurance provider for sure, providing credit cover. So this is just a very simple diagram, and this is something that we see time and time again. Under ordinary circumstances, up until the beginning of this year, managers of risk would realize we typically face these 4 risks. We face credit risks, market risks, operational risks, and other risks. I don't want to spend too much time, but in credit risk, the risk that a portfolio would decline in credit quality based on rating downgrades or poor underwriting decisions or commingling risk or dilution risk, things like this. In market risk, guys, we've had significant change since the beginning of the pandemic of the base treasury curves, of gilt curves, of euro risk-free curves, of swap curves. Foreign exchange rates have moved. I lived in the UK, so FX rates are moving. Got to tell you guys. And of course, commodity and oil prices and inventory prices are also changing. This is an ordinary risk that needs to be catered for in a portfolio, and including a securitization portfolio. Folks are working from home. Folks are working from home, and the risk of an operational error in managing complex transactions, given we're not working together, maybe some of the communications are not always ideal and collaborative as they should be or can be, means an operational risk can occur. So we can have things such as failure to train new staff joining since the pandemic. How do you train younger people joining your firm if they're not able to hear and pick up things? We can have data integrity issues, misallocation of cash. And of course, there's other risks, including the lack of a governance policy, fraud. I'm going to touch on fraud in a minute, and reputational, ESG, and stakeholder risks. So these are the typical four categories. Nothing new about this given the pandemic. However, as of March, we have seen, and we continue to see, and we've been predicting a number of these really since April, what I would call extraordinary risks given the COVID environment we exist in, given the economic fallout of COVID, let us say. We're seeing enhanced dilutions or deterioration of the quality of collateral pools. We're witnessing in cases where the sponsor of a securitization, the seller of assets, or even the collateral, cash flow risk morphing into true solvency risk. In other words, revenue is not coming in, cash flow is not being met, and that is actually threatening the very lifeblood of a firm. S&P has predicted, I think, about 20–25% default rate for SMEs in the United States, if I saw that right. So, this is where you see solvency now being questioned. There are collections risks with money not coming into the right bank accounts, maybe linked to the operational risk, risks of misrepresentation. But then there's this one at the top there, which is both high likelihood and high severity. And that's survival incentives for fraud. We've unfortunately predicted, and I think we've seen of other cases in the market and seen a few cases ourselves, one or two, where when you see a company who is doing everything it can, probably well intended to survive, and it has to make stark decisions between paying its senior debt, its junior debt, its trade finance line, its receivables, its insurance policy, or paying its staff, paying salaries, paying its rent. Doesn't need rent, I don't know, maybe doesn't need to pay the rent, maybe that's at risk. My point is, tough decisions are being made by companies now to survive, given this tightening liquidity profile. And you want to be aware of that. But how can we measure that change in liquidity risk as an asset manager? How can we do that given the environment we're in? It's very hard to call someone every day and say, hey, how's your liquidity, and be truthful. Well, maybe there are some technology solutions. This is a slide I'm going to spend a little time with in the following couple slides that we've been using at Channel, but other people have different approaches, but it's conceptually the same, looking at different areas to drill down on. First of all, looking at risk adjudication and risk prospecting, new client prospecting, and using tools. We like Wiser Funding at Channel, but there's many very good tools to provide risk adjudication provided by Moody's, S&P, and many other organizations, too many to mention, that will help you look at the quality of the client or sponsor or the portfolio as well at the portfolio level. Number two is predicting changes in liquidity profiles. I've already touched on that. We believe, especially for SMEs, that liquidity, having adequate liquidity and cash flow to support one's immediate expenses is a major determinant of survival or not survival in a pandemic like this, in the crisis we face in Europe and elsewhere. What we did earlier in the year is we teamed up with a firm called Data Sciences Lab in Amsterdam and worked with them to develop a model that could actually predict the cash balance of SMEs and companies using EU open banking architecture. And what that does is it facilitates bank account scraping. So this is clear technology being brought to the fore. And what we're able to do now with that technology developed and through open banking is we're allowed to have access to bank accounts of corporates. This is B2B. They grant us access for a preferred interest rate on their financing. And we're able to see several times a day their bank account balance. And in doing that, we also can get a sense going back in time, changes in liquidity profiles. What adds to liquidity? What subtracts from liquidity in terms of expenses? And then we can predict, even at a very granular level, tomorrow's balance and changes given what occurred in the back. And there is some AI going on in here. So this is a wonderful tool, especially with SMEs, to predict impact to liquidity in the future, given the past. I'm not suggesting it's perfect, because the crisis itself is an exogenous factor, but it certainly informs us a lot about risk management, and we're grateful to team up with DSL. Then we have enhanced verifications. And here what we've done is we've worked with firms, your accountancy firms and KYC experts to establish, first of all, 3 lines of defense at all times with our portfolio. A number of you are regulatory experts and you understand clearly what lines of defense are, but also do mini AUPs. I'll touch on that in a minute. And then I think the most interesting area for us in technology are the non-financial risks. And here we've teamed up with firms like Neotask, but there's many other good firms, Extra and others, that essentially look at the people risk and do a deep dive on the people risk or the company risk in terms of non-financial variables. For example, and Trustpilot is a website that does some of this, and it's all free. What do the employees of our clients say? Are they being paid on time? Or are they very upset and things aren't going well and they're predicting problems? That's an indicator. What are the clients of my clients saying? And you can get this information. This is online. People complain online and say things on tweets and elsewhere, as we know. And we can include this, and we can effectively scrape this data before doing a transaction and look back in time. We can also do a risk-adjusted rating of our clients and continue to monitor that over time. So we're having a number of conversations with counterparties about enhancing these measures to reduce non-financial risks. This is an example of not only looking at a sponsor of a securitization and its credit rating, but drilling down in the case of Wiser Funding, but any other credit adjudication tool, and looking at the underlying collateral pool. This is an example of the open banking and liquidity planning I mentioned earlier to you, AI powered to, again, predict tomorrow's liquidity given the past observations which we're allowed to do under open banking and with the client's consent. This is very exciting stuff here, guys. Very exciting to be able to predict a problem in the future, potential problem, from a risk management perspective. But it's also an opportunity to work with your client and help with customer experience and say, we notice you seem to be, getting a little bit stressed here. What can we do to help? So it creates a whole new dialogue with the client that we may not have had before. So we're obviously embracing these tools. Then we have enhanced verification and monitoring. We've been recruiting, in the case of Channel, leaders for third line of defense and KYC and AML risks, which we're seeing also as growing overall and across the marketplace. This is just a mini live case study, live in the sense that it actually happened, where a client approached us for trade financing. And we worked with our partner and provided, and this is all public information in terms of the web and deep web databases, where our partner went in and did a deep dive on a company and an individual seeking a $10 million line of credit for trade financing. Established person, established business. We had all the KYC and AML done. LinkedIn looked fine, had some references, had banking facilities in place with a certain high street bank. Let's proceed. And what we found in working with the partner is because this individual had a name before and changed their name, but they kept a common email address. They had an overlap of an email address under the previous name, and then they changed the name and they kept their email address. And that email address was linked to certain activity in a penitentiary in the United States. And then they came to the UK and they decided to set up shop. But their time spent on holiday there in the States was not shown to us, and they didn't tell us about that. We found out, and of course we passed on the business and notified the authorities, and of course did not tip off. But I'm giving you a live example I've seen recently of how these tools can mitigate risks when you're advancing capital as an asset manager or as a bank or as an insurance company providing trade credit cover. I'm aware of the time constraint. I'll do just 1 minute case studies more with permission, Lisa, and then finish up. So we'll be done in less than hopefully 2 minutes.
Sure,
Case study. Okay, thank you. Case study 1, we completed at the end of last year a financing for a UK-based RegTech firm. They had an investor come in, a private equity partner, and as a result of that, that private equity partner put a claim over all the assets, including the receivables and working capital assets of the company. That meant they could no longer use those assets to finance with their bank. They were coming up to November, it was near the end of the year, and they would then breach their agreements with their private equity sponsors because they needed working capital. I'm not convinced they had planned for the impact of the private equity combined with the pledge and the pullout of the bank. I just saw today one of the UK banks is closing over 150 branches, announced today, and we're seeing banks pull out. You know, first opportunity, something changes, they could pull out. So what we put in place was a hands-free financing with all of our collateral in a cloud-based system. And we got an agreement with the private equity house that to the extent we bought receivables and we had cash collected on the receivables, that was our asset. Otherwise, everything else was their asset. We moved very quickly, starting at around November 17th, and completed the financing in the middle of December. So we were very pleased with that. So that was a material financing with a securitization, true sale, with insurance for a UK RegTech-based firm. So we were very pleased to complete that, and I was involved a little bit myself on that. Number 2, we completed a very similar transaction this morning, but this one goes back 2 months, where we financed a fintech firm operating pan-Europe, Baltics and Western Europe in the SME space. We brought in a securitization solution for receivables and supply chain financing with trade credit insurance and virtual IBANs. But again, very much with that full suite, guys, of risk mitigation, from looking at credit adjudication technology, thinking about liquidity risks, thinking about concentration risks, and also challenging our client with respect to people and fraud risks, and making sure that they are on top of their risks at all time. So these are just 2 case studies or so of how we've sort of responded during the crisis. Technology is key to have. I'll stop sharing here and just finish my comments now. Hi, everyone. Technology is a key complement to the challenges that we face. And it's a key means to not only help better manage our risk and have a better investment outcome, but it also can drive customer experience. Thank you, Lisa.
Thank you, Walt. I realize, Camilla, that we're bumping up close to the end of our time here. We do have a question, and Walt, actually, it's primarily, well, at least for you in the first instance. So for each of you, but as I said, we'll start with Walt. Assuming that the solutions that you've described are successful, what is the next problem or challenge you would look to solve building on your success? And as I say, Walt, we'll start with you.
Okay, so I think I gave those four challenges and uses, applications for technology. I think that the next one would be in the area of KYC and AML. And there are some great technology providers. I won't name anyone. We use 1 or 2 in particular. This is a next area. I don't know if anyone saw this last week. I suspect many of the participants on this panel have, where there was a WikiLeaks type event for FSEN, for suspicious activity reports. And major banks, information were released about which clients they were issuing SARs on, suspicious activity reports. So this is an example of these risks are out there, and I think this would be the next area, Lisa, that we would look to further focus on and refine our efforts and apply technology. Thank you.
Okay, thank you. Akber, I'll hand over to you. Do you have an answer for that?
Yeah, I mean, I think there's a long way to go. I think the first thing is that it's not just going to be about netting. I think this is more the broader journey to help people understand the value of the data within their agreement and the opinions and advice, certainly expanding it to areas such as liquidity reporting, QFC record keeping and reporting. And then also kind of looking much more outside of the capital markets as well. You know, we see industries such as insurance really, although they are very much data enabled in other aspects, when it comes to management of policy wording and tying that back to things, unfortunately, yeah, quite poor in that regard. And you know, some of you may have been watching with interest with the recent test case in the High Court, the FCA versus Arch Insurance, which was looking at business interruption insurance. Now, the court there assessed a diverse range of policies and to see, you know, what the coverage of that business interruption insurance was in the face of the pandemic. The sheer volume of policies, you know, we had 700 different types of policies, 60 different kind of main insurers there, under 500,000 policy holders in the UK there. Really something that's crying out for the same sort of approach and use of legal tech, really to try and help connect wording to outcomes and what we need to do.
That's an excellent point. Brock, same question.
So I would say that new frontiers for us, I mean, obviously the space that we exist is a dynamic one where there are constantly new regulations, there's changes to existing regulations. That largely falls under the rubric of existing product and existing clients. There are a couple of things that our platform, particularly the latest version, allows, right? So I'll just describe two of those areas that we are actively exploring. One of them is, as you could probably see in the very quick demonstration, we have regulatory text that's parsed and annotated. The tools that we use to do that and imply the logic from the text itself are also tools that we can expose to our clients, and in fact, beyond our core financial industry clients, but to law firms, to regulators, to create a kind of discourse around the law. So the idea is that you can associate your own metadata, your own commentary on a text. You can share that. You can have a kind of back and forth on interpretation. You can write a document that actually compares, literally, you know, shows a diff. You can create a link to a standard place that's going to show you the difference between, say, a clearing mandate under ESMA regulations versus under CFTC regulations, and show points of comparison. This type of tooling is almost exhaust that we generate naturally as a byproduct of what our core product is. This is how we maintain it and keep it current. But we've seen a lot of interest in using some of these tools by our clients themselves, right? Both in the frame of horizon scanning and in terms of could they use this to start marking up and exchanging information about text themselves. So that's one area. Another area is taking the use case from pre-trade, where you actually have the frame of a well-constructed transaction, and moving it to the point of account onboarding, right? So when you onboard an account to trade certain types of products, you don't necessarily know the exact types of transactions you're going to do, but you have an idea as to why the account's being onboarded. You have partial information about that particular account that you may have inherited from your relationship with that counterparty. But the process of onboarding today is one that I think is quite sub-optimized from a regulatory perspective, just based on the fact that it's hard to answer the questions of exactly what documents do you need to exchange. Because in order to fully understand all of the data elements that you need to trade compliantly, you really need a good understanding of all of the rules that could apply to the potential transactions that you wish to do. One of the things that we can offer in that space is a kind of introspective or interrogation of the model of the law to say, look, if I want to trade cleared interest rate swaps in major currencies, and I want to trade these types of listed derivatives with this counterparty, what documents do I actually need to exchange, and what data elements do I need to have, and what are their values in order to be confident that I can transact compliantly. And instead of having a huge onboarding template where you exchange 47 documents, that might actually guide you to a path where you say, oh, I only need to exchange 8, and these are the key elements I need from those documents, right? So from the perspective of a fund manager trying to get accounts onboarded at a dealer, if the dealer has that type of technology, they could onboard them more quickly. They can turn that around faster. From the perspective of the fund manager, it's very much in their interest to be able to optimize that document exchange because it has real costs for them. So that's another area that we're looking to expand.
Okay, well, the sky's the limit. That's great. Camila, I have been asked to do the closing housekeeping here because we have run out of our time now, so I'm going to do that. And the first thing on my list is to thank the panelists for their contribution and the attendees for their attendance. That's a real pleasure for me to be able to do that. Camilla has instructed me to remind people that this event is one of a series of primetime virtual events. Details of further events can be found on the Primetime Virtual Events page of the P.R.I.M.E Finance website, and they will also appear in that chat box that Camilla is managing. We'd like to thank our sponsors, Droit Financial Technologies, Brock in particular, FTI Consulting, Morrison, Forrester, and Rudder Associates for their sponsorship of Series 2 of Prime Time, and also D2 Legal Technology, so Akber, for sponsoring this event, and Lexis and MLEX for their support as well. I would like to remind people also that we have this organization, Friends of P.R.I.M.E. It is a not-for-profit organization. It accepts donation to support its work. If you would like to make a donation or to find out more, please contact the Secretariat using the details shown in the chat box. And we will now, as Camilla anticipated earlier, take a 5-minute break before the second panel begins. As Camilla said, you do not need to dial out. Please stay dialed into the session for that. And that is it from us. Thank you very much, everyone.
Thank you very much to our first panel. So I'd now like to ask Joyce, Doug and Stephen to take themselves off mute and put their cameras on as we get ready for our next session.
There, I think I've taken myself off mute.
Thank you, Joyce.
Okay.
Hi, Stephen. Looking, yeah, that's great.
Thank
And
you.
Doug,
Yes, we're all here.
all right. Do you want to wait a couple of minutes, or should we? We're running a bit over time, so we could just keep going, Joyce. I'm in your hands.
I think we probably ought to get going unless Doug or Stephen disagree.
I'm good.
Yeah, okay.
Okay, all right. Thank you so much. We're having a few people join us just for this second session, so I'm going to repeat some of the housekeeping. Apologies for those of you who've already heard it, but welcome to Prime Time, brought to you by P.R.I.M.E Finance, and we're just about to start the session on digital currencies. This session is being recorded and will be distributed later. Attendees are muted and have their video turned off, but if you want to get in touch, you can use the Q&A function. It's helpful to include your name and affiliation, and we'll be using the chat box to send messages to everyone during the course of this session. Thank you again to Droit Financial Technologies, FTI Consulting, Morrison and Forrester LLP, and Rudder Associates for their sponsorship of the second series of Prime Time, and D2 Legal Technology for sponsoring this particular event. Thank you also to Lexis and MLEX for their assistance with promotion. I'll now hand straight over to Joyce Hansen. Joyce is the former Deputy General Counsel and Senior Vice President of the Federal Reserve Bank of New York. She's also a P.R.I.M.E finance expert, and Joyce will introduce the panel and moderate the session. Thank you, Joyce.
Thank you, Camilla. We have a terrific panel upcoming, and I am pleased to introduce our two speakers. The first is Stephen Schwartz. He's the Distinguished Professor of Law and Business at Duke University, the founding director of Duke's Interdisciplinary Global Financial Markets Center, a senior fellow at the Center for International Governance Innovation, and a P.R.I.M.E finance expert. Our second speaker is Doug Arner. He is the Kerry Holdings Professor in Law and the Director of the Asian Institute of International Finance Law, University of Hong Kong, and a P.R.I.M.E finance expert. I want to say at the outset that we are going to be taking questions immediately after each speaker presents their scholarship and their information. And so I encourage you to continue to put Q&A in the chat as we go along, because we're really eager to hear your questions. And so now I will turn it over to Stephen. Take it away.
Okay, thank you, Joyce. Thank you, Camila, and pleasure to be here. I'm going to talk about central bank digital currencies and law. And I know Camila is going to give a link to the paper for anyone who wishes to look at it. It's fairly short and it's on SSRM. The first thing I should point out is that there's immense confusion about the terminology as to what a central bank digital currency actually means and to whom it should apply. And again, I'm focusing on the retail use of such a currency, one that's used by consumers on a day-to-day basis as an alternative to cash. In terms of the confusion as to what such a currency actually means, there's a question, should it be blockchain-based? If blockchain-based, should it be recorded only by central bank, or should it use distributed ledger technology? And also, should it be account-based? And if it's account-based, should it be accounts at the central bank? In the US, for example, every consumer would have an account at the Federal Reserve, a Federal Reserve Bank? Or should it be some sort of what some refer to as a hybrid, which is managed and coordinated by the central bank, but each retail consumer's account will be with the non-central bank, the commercial bank or savings bank that consumer presently has an account with. What I envision, at least as a first step for a central bank digital currency, is one that is account-based, not blockchain or distributed ledger technology, and furthermore, that the accounts would be the existing accounts that the retail consumers would have with their own non-central banks. And the idea as to why this might be referred to as a central bank digital currency is that the central bank in each country would prescribe things like the interest rates on the accounts, and more importantly, they would set the rules and regulations for the governance and use of these accounts. So at the outset, I should emphasize, I do not contemplate central bank liabilities that consumers would deposit money in the central bank, which is, of course, legally the equivalent of making a loan to the central bank. Now, under the type of central bank digital currency I envision, I believe that technologies are already largely in place. And moreover, I believe that the legal infrastructure is already largely in place, with the possible exception of consumer protection laws. And I refer to what are called electronic wholesale funds transfers. Banks, financial institutions currently engage in electronic funds transfers for most of their payment system. And these transfers are actually governed in the United States by Article 4A of the Uniform Commercial Code, i.e. the UCC. In the European Union, they're governed by the European Directive on Payment Services in EU internal markets. And in terms of looking at a template for a legal structure, I think the Article 4A template is more detailed and probably in many ways more precise than the European directive. And furthermore, Article 4A parallels, or I should say, the Uncitral, United Nations Commission on International Trade Laws, model law and international credit transfers parallels Article 4A. And both the Uncitral model law and Article 4A influence the EU directive. So essentially, what my paper shows, and I'd be happy to take Q&A on this, is that transferring funds from one customer's electronic bank account to another customer's electronic bank account should be the same in principle, whether the transfer is retail or wholesale. And again, I think the only significant difference would be the consumer protection laws. In the United States, there is a specific statute that would govern consumer protection of electronic funds transfers. And I believe that taking some of the basic principles from that statute, which, for example, limit consumer liability for certain mistakes and fraud, could be adapted and grafted onto a legal structure like Article 4A of the UCC. There are, of course, other concerns that one needs to think about. If we were to somehow channel the consumer funding electronically, could there be, a greater chance that third parties could obtain the private data? So you have privacy concerns, and these privacy concerns could at least be dealt with better, I think, by the hybrid system, where you have each consumer using his or her commercial account, than if you were to centralize all the information in the central bank itself. There were other issues. For example, I know in the last panel, someone mentioned the anti-money laundering laws. I think they did in the last panel. And these laws follow recommendations of an intergovernmental body, the Financial Action Task Force. In principle, I think no change would be needed to these laws. But in practice, I think if you would extend electronic funds transfers to consumer realm, then you would have many, many more transactions. And as a matter of cost, it'd be hard for each commercial bank to really know your retail customer. And so those laws might impose some threshold. The other question might be what governmental entities should get involved with international retail funds transfers. And that's a more technical question. The paper itself suggests that the national regulation or regulation at the national level should be sufficient to cover that, and gives examples of cross-border transfers. That does not, of course, rule out the potential value of establishing an intergovernmental body like the Financial Action Task Force that might meet and recommend best practices for retail electronic funds transfers. The last question, and then I'll stop, is do we have technology that can actually facilitate all these retail transfers? And I believe that answer is yes. The clearinghouse is currently finalizing its real-time payments network to facilitate retail real-time funds transfers. And the Federal Reserve is working on its own interbank real-time funds transfer service. And of course, issues like China, I will let Doug speak to. So that's my presentation, and I'm happy to accept questions.
Thank you very much, Stephen. Those of you in attendance, please use the Q&A box to submit your questions. And perhaps as we wait for the audience to submit the questions, I could start out with a question for you, Stephen. You have suggested that your scholarship is on the account-based CBDC, and you have articulated the advantages of that. But could you talk a little bit about how one that isn't account-based would be designed and operated, and talk a little bit more about why you think one or the other is better?
Sure, and let me also share the screen and show everyone what I would envision. And what I'm going to do is really cool. I use this for teaching. It's a digital camera, and actually I can do diagrams on a real-time basis. So what I'm contemplating here, this would be the type of commercial bank account-based facility. So let's assume Joe wants to make a payment to Sally. It would be quite simple. Joe would electronically order Joe's bank, a receiving bank, and the receiving banks are essentially commercial banks, to make a payment to Sally's bank. Under the Article 4A and Untitled Model Law terminology, Joe would be the originator. This would be a payment order. Joe's bank would be called a receiving bank. It would give a payment order to Sally's bank, also called a receiving bank. And Sally's bank would make the payment to Sally, the beneficiary. Their whole issue of all the types of concerns that you would have with electronic funds transfers, like risk of loss, a very significant concern. For example, if Joe orders Joe's bank to pay Sally, and Joe's bank pays Francis instead, the money would go to the wrong party. Or if Joe's bank basically orders Sally's bank to make the payment, and then it turns out there are insufficient funds in Joe's bank, to enable that payment to have gone through, Article 4A of the Uniform Commercial Code covers all of those concerns already. And so you have an infrastructure as which you already have the groundwork on technology, and as to which you have a lot of experience in the wholesale transfers. If you have another type of system, and let's assume you have a distributed ledger technology system. I've not independently done the work, and I'm sure Doug can speak, but Canada, the Bank of Canada, along with certain private groups, has recently done a study referred to as Project Jasper, and that looked at the use of distributed ledger technology in the wholesale payment system. And the findings just came out, and there were concerns about operational resilience. They looked both at using Ethereum as a blockchain DLT platform, and also Porter. And they did not conclude that the technology was yet sufficient. Just the volume of the trades, and that's on a wholesale basis, not even a retail basis where there would be many more trades. The other question is, should central banks, should each consumer have an account with the central bank? And as I mentioned, not only would sort of concentrate the privacy concerns and the ability of a party to hack into the central bank's data network, which would sort of create a systemic problem, but that also has the transaction costs of each consumer having to open an account with the central bank. I don't think that is needed where you can have the commercial banks act essentially as agents of the commercial bank according to rules that the central bank would establish.
Right. Yes, I think having the accounts all at the central bank could have some disintermediation effect, certainly on the financial system as well, which would be significant. Doug, please also jump in with any questions if you wish. I did have another question for you, Stephen, and you have looked to the well-developed commercial law in the US, which is state law. Article 4A is part of the UCC, which is a commercial law system that has been very effective. It is very well developed, but it does require each state to adopt provisions, and to the extent any of the framework you described needed to be adapted for CBDC, it would require state by state enactment. So what, would you comment at all on the sort of pros and cons of relying on a state-based legal system versus having these issues addressed at the federal level?
Sure. Certainly, logically, federal law makes more sense because this is, this would be run nationally. The rules would be by the central bank, which in the US is a federal bank. And in any system that you have federalism, you would have, this system being national. In the US, the Uniform Commercial Code, UCC, governs commercial law, even though commercial law is largely interstate, not because it's more logical to have state law, but because the state law is just so damn good. And the UCC is promulgated by two private organizations that have public interest, the American Law Institute, which is now a national but has international members, and the Uniform Laws Commission. And both of these bodies draw from the very best of the legal profession, I would say, not only academics and judges, but practicing lawyers and so forth, to come up with fine, really good laws, uniform laws, and to update those laws from time to time. And so far, Congress has not thought necessary to preempt commercial law in the US. And so if you had, in terms of the laws governing a central bank digital currency, if they were as well crafted, then I think, I'd be indifferent as to what jurisdictions enacted them. I will say that the paper I've done doesn't really say that one governmental unit or the other should enact these laws. And in fact, the paper itself would be as applicable to non-US jurisdictions as US jurisdictions. It sets forth the key principles as to how this should be regulated and as to how those principles are actually legislated. I'm indifferent as long as they are well legislated.
Thank you, Stephen. We should probably, in just a minute, move on to Doug, but I'll ask you one final question and hand it over to Doug, and if he wants to ask you a question, I encourage him to do so. So Governor Brainerd, governor of the Board of Governors, gave a speech recently and talked about some of the work the Fed is doing in exploring central bank digital currencies. And I was intrigued by the fact that one of the legal issues that she highlighted among many that could have been highlighted is that it would be important to have CBDC have legal tender status. And I found this interesting, given the very narrow definition of legal tender has in the US as coin and currency, and that is true in other countries, including the UK. And it doesn't seem to play much a role in payments these days. No one is required, no private person is required to accept coin and currency in payment of debt. So I was interested in your view on that, and why, is that important or is it not important in today's modern payment systems?
Well, that's an interesting question, but I'm not sure it's actually a meaningful question in the context of the retail central bank digital currency that I'm contemplating again here. First of all, I should point out that I'm unaware of that question ever coming up in the context of wholesale electronic funds transfers, of which there are billions of dollars of those transfers probably every day, and have been for decades. But I think more fundamentally, the electronic funds transfers I'm contemplating they merely represent transfers of legal tender. And I don't think anyone would say that the transfers themselves should constitute legal tender. So I have here like a dollar sign, and when the currency, when the order goes from Joe to Joe's bank and Sally's bank to Sally, eventually there would be a credit showing up in Sally's bank that would entitle Sally to go to her bank and withdraw dollars. Okay, the dollars would still be the underlying legal tender. I don't think that would change at all. This is simply a mechanism of essentially ordering how the transfers would take place. And for those of you who are really commercial law geeks, I will tell you that this system of electronic funds transfers effectively represent what in the United States are referred to as drafts. And so there are two types of negotiable instruments. There is an order, like a promissory note. I basically, pay to the order of Doug Arner. And there's a draft, which is I order my bank, the jury, to make a payment to Sally. And so this is like a two-step order. Joe orders his bank to make the payment, and then essentially the payment, then Joe's bank orders Sally's bank to make the payment. And I don't think anyone has ever asked, are negotiable instruments that are effectively the, a substitute for cash, are they legal tender? I mean, they're not. They're simply payment orders, which is all this would be.
Joyce, I'm going to jump in on that one, because I think when we look outside at a lot of countries that are looking at these issues, there are actually two things that come up there. The first is what you mentioned about notes and coins. Central banks thinking about CBDC projects often question whether they have the legal authority to actually look at this. And so, if you have essentially a central bank power to issue currency in the form of notes and coins, which is a very common central bank provision, there's actually a question for many central banks taking a very literal reading about their currency issuing powers, about whether a digital form actually would fall within the scope of notes and coins. And secondly, you actually have a surprising number of central banks around the world, particularly in developing countries, that do not have direct authority over the payment system. And so if you're stuck with a central bank law that says you have power to issue notes and coins and you don't have authority over payment systems, you're actually, when you're trying to deal with these questions around central bank digital currencies, it becomes very difficult. And, you know, I think this question around legal tender really comes from, it's been a sort of ongoing debate that started with Bitcoin. And it's something that I think, you know, the monetary economists for several decades really haven't had anything to argue about. And Bitcoin, cryptocurrencies, and now CBDCs are giving something to argue about, to discuss. And one of the questions that comes up is, you know, is a cryptocurrency, a non-central bank issued digital currency, is this money? Well, when we think about money, money is basically a functional or an economic definition. It's only when you get to currency that you are talking about something that is a legal definition. So when we talk about money, money could be anything. But when we talk about currency, that is something that falls within a very specific, in many countries, legal provision. And so there's often, once we get to these digital questions of a central bank issuing a digital currency, it's very important to make clear that the digital representation is the same as the paper. And that requires that sort of statement.
Right. Great. Thank you. Thank you very much, Doug. We did have one other question, but I think maybe we can return to it later. And so I'm going to hand it over to you, Doug, at this point to tell us about your work.
Thanks, Joyce, and thanks, Stephen, for a very good presentation. Thanks to Camilla and the whole P.R.I.M.E team for the invitation to be here tonight and a really good first panel. I'm going to share my screen and go through just a couple of slides. And, you know, what I'm going to talk about really derives from a couple of different papers, one looking at digital finance and COVID-19, which really bears on some of the points from the first panel, and then a second one called After Libra, the Digital Yuan, and COVID-19, which looks at central bank digital currencies. And I think the key point, and it parallels some things that Stephen was saying, is that we're in a position today where the technology is no longer really a constraint when we talk about money and payment systems. And, you know, if we think about money, payment, finance, they've always been co-developmental with technology. But obviously that's something that with digitization has dramatically increased. And I think if we're looking at the sort of technological developments, we can really see this coming from two different directions. One on the centralized side, I think Stephen highlighted many of these, and second on the decentralized side. And if we look at the centralized side, many of us will be familiar with, over the past several decades, the evolution of RTGS systems, of mobile money, of e-money, more recently of fast payment systems. And the fact that from the standpoint of a centralized system, these systems have gotten sufficiently powerful, as Stephen says, that you can literally build a system whereby you can provide an account for every person in a country. As Joyce highlighted, because we've become somewhat accustomed to our intermediated payment system and the intermediated banking system, we're very reluctant to put in place something that could essentially sidestep or replace that in many cases. So that is one side. The second has been really over the past 10 years in the aftermath of the development of Bitcoin. And certainly, if you think about Bitcoin, it was originally designed to be a technological alternative to sovereign fiat currencies. Now, Bitcoin has been extremely interesting from the standpoint of a largely independent, decentralized system. But from the standpoint of money, it's not very good in any of our monetary functions. It's not very good as a unit of account. It's not very good as a store of value. It's just not very effective. It's too volatile, it's too expensive, it's too slow. None of these things work very well. And so, with the exception of certain countries where the sovereign fiat currency is highly unstable or ineffective, Bitcoin has not emerged in any way as a major challenge to major currencies. But coming out of that, a lot of discussion about the potential of distributed ledger technology and blockchain, both permissioned and permissionless systems. And so really from the advent of Bitcoin up until, we could say, 2019, a lot of central banks around the world were running a range of sort of experiments, investigations, et cetera, to look at the potential of DLT and blockchain in the context of existing digital systems. After all, any centralized digital system will have a given lifespan and will eventually need to be replaced. And so you might as well investigate the new technologies. And by early 2019, BIS survey of its membership showed that pretty much most of its membership had concluded that DLT as of that point was not sufficiently robust or fast to, or secure even, to serve as a good alternative to many of the centralized systems which we had become used to. In the world of money and technology, something very important changed in the middle of 2019. And that was the announcement of Facebook of the Libra proposal. I think when we look at the monetary history of the 21st century, there is before Libra and there is after Libra. And honestly, it doesn't matter whether Libra ever launches, though it's looking like it probably will in some form or another. But the reality is just the announcement of what could be, what would be the world's first global stablecoin, a stablecoin, a private sector instrument fixed in some way to a fiat currency issued by a huge data platform company with billions of users and the possibility of rolling out literally to hundreds of millions of people in a very short period of time. This was an existential challenge to many central banks all over the world, and it necessitated a response. And I think what we can see from the BIS survey of central bank CBDC intentions at the beginning of this year, beginning of 2020, pre-COVID, is that a large number of central banks were now looking at the issue, and a substantial number, close to 30%, were actually looking at putting in place some sort of system in the next few years. And I think that one can say that Libra moved the discussions forward very dramatically. But to actually make things happen, it took COVID-19. And it was really the pandemic, the financial response, the digitization process, as well as increasingly in the US and other places around the world, discussions about how one can not only build a system that is better able to get financial resources quickly all across a country, but also from the standpoint of building more robust systems going forward. I think if we look at some of the impacts, we can see this in RegTech, we can see it in AML, digital ID, concentration, and of course, digital payments and central bank currencies. And I think, as Stephen has highlighted, if we look around, there are a variety of ways that you can structure a central bank digital currency, and lots of different discussions, lots of different approaches in different places. Big difference between a sort of public system and a more private system, a system that is account-based or token-based, one that is based on a blockchain system or on traditional centralized technology. Probably one of the biggest divisions between countries looking at this is retail versus wholesale systems, and certainly in the Chinese context, domestic versus foreign. When we look at some of the big issues in system design, interoperability with other monetary instruments in an economy. Some are designed to be monopolies, to replace other monetary instruments. Others are meant to interoperate, to operate in parallel. Is it going to be cashless? Is it going to interact with cash? Is it going to be a cash substitute? How's the governance structure work? What is the relationship to the central bank balance sheet? Key from the standpoint of embedding a monetary instrument into other digital applications like blockchain is the question of finality. Obviously, security. If you are building a fundamental digital public infrastructure like a monetary system, security is key. Privacy. An article in yesterday's Financial Times talking about the design of the Swedish system and the idea that privacy is a design feature in a central bank digital currency, and it's a very important one. Competition and the international and regional context. So I just want to hit a couple of quick examples and then move on to the floor. If we look at China, I think China announced more or less this time last year in the wake of Libra that it was going to move forward with an eventual system called DCEP, Digital Currency Electronic Payment. As Stephen suggests, this is a public-private system. It is designed to be a central bank issued digital monetary instrument, which then operates on existing payment systems, whether those are the sort of wholesale systems like China UnionPay or the existing RTGS system, or it is the sort of e-money, mobile money sort of systems of Alipay and WeChat Pay. The design is that this would be the M0 instrument that would then unify all of those systems. The intention is that eventually it would replace cash, and it would be something that would be private, but to the extent that the central bank and other regulators would potentially have access to the information. It's currently pilot testing in a number of cities, in a number of different contexts, with probably an expectation of rollout in 2022. Why? Monetary policy, financial crime, social policy, technology and innovation, blockchain to embed a monetary instrument into blockchain. Dollar alternative, certainly, and certainly risk management from the standpoint of things like foreign exchange controls. Discussions around a digital dollar, and we can see a range of different discussions, some of which are account-based, others of which are token-based, a mix of retail and wholesale for a wide range of different objectives. And certainly most recently, this comes from the just launched last week EU digital finance strategy, and highlighted here support for the ECB to consider issuing a retail central bank digital currency. We already have pilots going on between Société Générale and the Banque de France looking at experiments with wholesale systems. Almost every week there's a new announcement. Bank of the Philippines this week, ECB last week with Christine Lagarde speaking about the issue the week before. And I think if we look forward, very much agree with Stephen's point. The technology is now there. And the reality is that because of Libra and a number of other reasons, central banks are looking at this in a very serious way. And to the extent that you begin to have one or more major economies, major currencies, releasing CBDCs, that then puts pressure on the other major economies and major currencies to come out with their own offering. As those come out, because of the role of those economies and currencies in the global economy, this is something that pretty much everyone else has to deal with. And so if we look at it, we divide the approach between the major economies, and in particular, the largest economies. If we look at the US, EU, and China, we then look at your sort of financial centers, the UK, Singapore, Hong Kong, Switzerland, which often have a different focus, often more of a wholesale and an intermediary node sort of function, compared to the major economies. Then you have other developed economies, with Canada and Sweden probably being the leading examples here, very much focused on cashless, and a large number of developing countries. And this is one where you're seeing a range of different approaches, because I think there's a difference between a major economy where you have well-functioning payment systems and a developed banking system versus a developing country where you don't have those. If you don't have a well-functioning payment system, if your banking system essentially doesn't work, then the attraction of a centralized system which disintermediates your banking system but achieves national financial inclusion at a very efficient level can be something that is very attractive. And we're seeing proposals like this in Cambodia and a range of others. So I think what we're seeing is different approaches in different places. But the key is that because of this amalgamation of factors, it's no longer a theoretical process. These are rolling out rather quickly in rather sophisticated form, but central banks are rather conservative institutions, and I think we're probably still a couple of years away from our first major currency CBDC. Thank you.
Thank you. Thank you, Douglas. That was wonderful. I find it interesting, you know, you pointed out that different economies that are considering the issuance of central bank digital currency are doing it for different reasons and trying to solve different problems to some extent. And yet it's somewhat ironic that the catalyst for moving more quickly is competition from the private sector in Libra, and perhaps the threat that different economies see by that. And I wanted to mention something else. It's not really, you could comment on it if you like, but you know, in the US, there's the Digital Dollar Project, which is a private sector project between academics and Accenture. It has a former CFT commissioner, Giancarlo. And you know, we've talked about the private sector being involved as intermediaries in the system, but they seem to have an idea of this group actually being involved in the design of a digital dollar. And in response to that, the chairman of the Federal Reserve Board, Jay Powell, quickly stepped in and said that it was the central bank that should design the CBDC, not the private sector. And I thought that was another interesting example of the desire to, you know, take a little bit of control of this project, this concept, and not let the private sector take it over, essentially. Yeah.
Yeah, no, I think that's a very important point. And it's actually something that Stephen mentioned as well, though, is how can we think about how to bring the things together? And one area where we've seen this historically is in the context of RTGS systems, which are very often a sort of public-private initiative. But the central bank is playing a role in providing liquidity or support, but also supervision of the system, which then is enabling of the private sector. And we can certainly see how this sort of approach going forward has some real potential. But yeah, I think you're exactly right. I mean, central banks, this is something that, you know, the central bank monopoly in many places over issuance of currency only emerged about 100 years ago. But it's something that central banks are very jealous over. And Bitcoin didn't end up to be much of a challenger, but Libra looked like something that could have been more of a challenger. And from the big countries, it's now been fully brought into the regulatory system. But you know, from the standpoint of developing countries and emerging markets, the currency substitution of effect of a potential Libra is still real.
Doug, I have a question. To what extent, if any, do you feel that the central bank emphasis on blockchain and DLT, distributed ledger technology, at least for the countries with a developed financial infrastructure, is really unnecessary, but the central banks are perhaps looking at the latest media, attractive. Now, I would think that blockchain and DLT may well be important for countries that have less developed financial infrastructures, because people may trust those private systems more than the government. I'm wondering if there is this, I guess, for the most developed countries, whether it's unnecessary, and for other countries, whether there's, maybe it's more important.
I think this is the key, is that most of the proposals so far are not necessarily on the basis of blockchain systems. Even the Chinese system appears to be a centralized token-based system. It's a centralized issuance of digital tokens, not distributed. And that's something that I think, it's, as I mentioned, there's a lot of familiarity. The centralized technology, the centralized sort of approaches have proven to be very robust and very fast. And the decentralized approaches, certainly no central bank is really looking at a fully sort of permissionless system. That would be interesting if one were, but no one really is. They're all sort of permissioned systems of some sort. And I think it kind of depends on what you're looking at. And, if you're thinking of a sort of financial inclusion approach where you're trying to get access to accounts to the sort of unbanked, whether it's in the United States or it's in Cambodia, you can imagine either token-based systems or account-based systems. One can imagine, though, from the standpoint of, say, the United States, and this goes to the Digital Dollar Project, which is very much a blockchain-focused project, that if you're looking for a digital equivalent of the US $100 bill that can circulate easily outside of the country, a token-based system may be more attractive to users than a centralized system. So I think you're right, the technology on both sides, centralized technology is highly robust. The decentralized technology, most are looking at it only from the sort of permission structures.
We're running out of time, but we do have a few questions that I think are quite interesting. And Bob Pickle has referred to a recent headline on BBC News that read, "One day everyone will use China's digital currency," quoting Chandler Guo, described as a pioneer in cryptocurrency, talking about DCEP. What do either of you think, or both of you think, about that view that we will all be using the digital yuan?
Well, I mean, I think China would like that. I mean, it seems to me that certainly one of the goals of the Chinese development is to try to make the yuan the major international currency, replace the dollar. So there are a lot of political issues there. But Doug, I'm going to defer to you because you're much closer to what China's doing there.
Yeah, I think certainly you're right, Stephen, and it's clear that there are a whole range of reasons underlying the process. But to the extent that you can build a sort of robust digital monetary and payment environment that allows transactions outside of the existing US dollar framework. And this is something that is, of attraction to a range of users. And so, in some ways, because of the importance of China as a trading company, as a trading country, it's probably right. Everyone will be using the digital yuan in some fashion because of the trade flows. And that's something that's not surprising. Does that necessarily mean that it will displace the dollar? Certainly not. But certainly the initial design of the currency is largely to be limited to the domestic context, because there is a fear, and this has been one of the things that's actually slowed down the development of a CBDC in China, a fear about how it could weaken capital controls. So at the moment, it's designed not to flow outside, but it is eventually the thinking to support that.
We have one more question, and it's from Manuel Conte. He says, let's assume the supply of CBDC by a central bank was demand-driven and potentially unlimited. Could this facilitate bank runs under some scenarios? If, on the contrary, the supply was subject to constraints by the central bank, could this at a point make bank deposits trade at a discount vis-a-vis the new digital currency? Interesting question.
Yeah. Well, I think that certainly under the arrangement that I've proposed, which is somewhat of a hybrid, I don't think it would change the dynamics for a bank run at all. It's simply a transfer system. To the extent you created accounts at the central bank so that every retail person, every consumer would open an account at the retail bank, that of course would create the possibility that if there was concern about the retail, about the central bank being able to repay them, they could do a run in the central bank. And of course, the question then is, what would that mean? Would the government support the central bank like FDIC insurance now? Would there be unlimited funding of the central bank? So you would have, that might be another reason that you might want to have the hybrid system and keep it in the commercial bank, so you don't have to start rethinking how to prevent bank runs. Because, central banks don't have FDIC insurance or the equivalent. Of course, if you had a firm government backstop to say we're going to support our central bank, then that would, I think, at least greatly mitigate this bank run issue.
I think that's exactly right. And I think we're seeing some very interesting discussions amongst central banks all over the world around these. And one question is actually whether it might, in a crisis, trigger bank runs if you had an account-based system at the central bank. In other words, in the context of a panic or a crisis, would there be a preference to have money at the central bank as opposed to in a bank? And so the risk would be that actually, if you had a central bank system, and also a parallel banking system, in the event of a crisis, you could actually run the risk of drawing all of the funds out of the banks and into the central bank, which is exactly what you would want to avoid. And no answers to these questions, but it is these sorts of questions that is slowing down some of the projects, not the technology.
Thank you. Yeah, very interesting question. And I think we could continue for some time on these issues because they're so fascinating, but we've reached the end of our time and have gone over a little bit, but I want to thank both of you, Doug and Stephen, for a fabulous presentation and all the intriguing issues that are raised by central bank digital currency. I want to again say that this is one of a series of Primetime virtual events, and details of further events can be found on Primetime virtual events page of the P.R.I.M.E Finance website. Camilla is showing that in the chat box now. I want to thank the sponsors, Droit Financial Technologies, FTI Consulting, Morrison & Forster, and Rudder Associates for their sponsorship of Series 2 of Primetime, and D2 Legal Technology for sponsoring this event, and Lexis and MLEX for their support. Friends of P.R.I.M.E is a not-for-profit organization and accepts donations to support its work. And if you would like to make a donation or to find out more, please contact the Secretariat using the details shown in the chat box. Again, thank you so much for your wonderful presentations and all of the discussion we've had. I've enjoyed it tremendously, and I'm sure I speak for our participants as well. Thank you again.
Thank you, Joyce, and thank you, Doug.
Joyce.
And thank you, Camilla. and all of Prime Finance for organizing this event.
Great.